In the last lesson, we learned that stocks can be classified into defensive, moderately cyclical, and cyclical. In this part of the video, we are going to go a bit deeper, and I am going to discuss with you the 8 stock investment categories which I use when making investment decisions or strategies. Before investing in any business, it is important to know why you are buying into that company. For example, are you buying to aggressively grow your money, which is capital gains, or are you buying to receive monthly income in the form of dividends? Or are you that investor who doesn't like the drama of market volatility, so you just want to buy the so-called boring but reliable businesses where your money can grow slowly but without the drama of volatility? So you gotta know your motive. Like any dietitian will tell you, to be healthy, you need to eat a well-balanced meal. You must have a well-balanced diet full of proteins, vitamins, carbohydrates, good fats, etc. Similarly, with investing, to have a resilient and healthy portfolio of companies that will ultimately make money for you in the long run, you need to have a good mix of companies from the various categories which I am about to discuss with you. Remember the end goal. The end goal is to construct a high return, low risk portfolio of companies. You have to diversify among the 8 stock investment categories. So what are these 8 categories I'm talking about? They are large cap, predictable, cyclical, speculative, turnarounds, dividend, deep value, and ETFs. So let's go through each one individually. Let's start off with large cap growth companies. These are companies which are valued at over $10 billion. These companies are still growing at growth rates of greater than 20 to 25% per annum. The majority of these companies tend to be in the technology sector or are in secular growth industries such as cybersecurity, e-commerce, and software. Now, because these companies are growing at such fast rates, a lot of people tend to buy them and they are willing to buy them at a premium. So that is why, under normal circumstances, the stock price is usually overvalued. So it is very important as an investor to exercise patience and buy only when these companies are undervalued due to a temporary crisis or bad news. And trust me, each company goes through a rough patch of either bad news or temporary crisis that is not related to the business. And during those times, these companies become mispriced, and that's why we take advantage as investors. So it is important that you exercise patience. Now, these large cap growth companies, they can be divided into 2 sections. You have the companies which have wide economic moats that last for decades. The economic moat may be caused by a brand monopoly or high switching costs or network effects, which we are still going to talk about in later lessons. But effectively, wide economic moat companies are companies which have little or no competition and they are a monopoly in their field. And you also have companies which have a narrow economic moat, meaning that they've got a lot of competition. They may have that small competitive advantage against the competition, but they have got very strong competition from other companies, and that competitive advantage may be in the short term. So in terms of narrow moat companies, I usually take a small position whenever I decide to buy into those companies because they are a risk. For example, wide economic moat companies would include companies like Alphabet, Amazon, Meta, Adobe, and Microsoft. On the other hand, narrow moat companies would include NVIDIA and companies like Capitec. Now moving on to the next category, which is large cap predictable companies. These are companies that sell products or services that are a daily necessity and seldom change. These are companies that sell toothpaste, detergent, beer, chocolate, and so on. These companies are defensive in nature. They are large and have wide economic moats and predictable profits. That is why we like them, because they are predictable and therefore we can project their earnings to the future. This means also that they have low volatility because they are predictable. These are the so-called boring and predictable businesses. They have moderate growth rates of 5 to 10% per annum. So what we do is that we buy when selling at significant discounts, when the company is going through a temporary crisis or non-financial standard. It is very important to make money buying into these companies. You have to buy them at significant discounts. That is why we also, like with large cap companies, we exercise caution, we exercise patience. We wait until they are significantly undervalued due to temporary crisis or scandal. Examples include companies like Clicks, Discam, South African Breweries, Colgate, Yum Brands, Johnson & Johnson. We now move on to the third category, which is cyclical stocks. These are companies in capital-intensive industries such as real estate, banking, manufacturing, shipping, and airlines. Their performance is dependent largely on the economic cycle. They make a lot of money during economic booms and make less or even lose money during recessions. So what do we do with these companies? We buy when they are near the bottom of their cycle and sell when they are near the top of the cycle. But you will ask Mzamo, how do you know that these companies, they're at the bottom of the cycle? And how do we know that they're at the top of the cycle? Okay, let's start with when they're at the bottom of the cycle. How do we know? When the company is generating low profits or temporary losses and is significantly undervalued, and when the price is near support levels of long-term charts, either a weekly chart or monthly chart, we know that they are more or less at the bottom of the cycle and it is time to buy. So how do we know they're at the top? It's the exact opposite. When they are generating high profits and they are overvalued, and also when the price is near resistance levels of long-term charts. I'll give you an example. This is the chart of Visa. So Visa, you can see, is very cyclical. It's up, it's down, goes up, down, goes up, down, it goes up. So where will we buy? This is where we will buy when they're at the bottom of the cycle and are sitting at a very strong support level. This is where we will buy. When they hit this line here, which we call a support level, we will buy over here. We will buy at these levels. And where will we sell? We will sell at these levels. When they are at the top of the cycle, when they hit a very strong resistance line. So this is where we will buy. So we buy at the bottom, we sell at the top. We do not hold these companies for long periods of time because they are cyclical. We buy bottom, sell at the top. I hope that is clear. So this is the end of the lesson. We will continue with the other categories in the next videos.